There is a number sitting inside the tax code right now that lets you legally pay the IRS absolutely nothing on money you invest. Not a lower rate. Zero. And almost nobody structures their finances to actually reach it. Let me show you two people. Same country, same tax laws, completely different outcomes. Person one sells some stock they've held for a couple of years. They made a nice $20,000 profit, but because their income puts them in a certain bracket, they get hit with a $3,000 tax bill on that gain alone. Person two makes the exact same $20,000 profit. Same stock, same year, they owe nothing. $0 to the IRS. So what's actually different here? It's not luck. It's not a fancy accountant hiding money offshore. It's one number and one decision made months in advance. Here's the secret most people never learn. If your total taxable income falls under roughly $47,000 as a single filer, or around $94,000 for a married couple, your long-term capital gains rate is officially 0%. Zero. Written right into federal law. This isn't some secret handshake for millionaires. This is most useful for retirees living off savings, people between jobs, entrepreneurs in their first slow year, or literally anyone who has a lower income year for any reason at all. The wild part? The IRS built this bracket into the code on purpose to encourage long-term investing. It just sits there, unused by millions of Americans who never learned the rule existed. So here's exactly how you make this work for you, step by step. Step 1. Calculate your actual taxable income for the year, not your gross income. This is after your standard deduction, which for 2025 sits around $14,600 if you're single, or about $29,200 if you're married filing jointly. Step 2. Check where that number lands compared to the 0% threshold. If you're underneath it, any long-term capital gains, meaning investments you've held over a year, can potentially be sold completely tax-free. Step 3. If you're close to that line but not quite under it, there's a move called tax gain harvesting. You sell just enough of your winning investments to fill up that 0% bracket without spilling over into the next one. And here's the part that surprises people. You can buy that same stock right back immediately afterward. There's no waiting period required like there is with tax losses. But here's the catch almost nobody thinks about. This window works best during specific years of your life. A gap year between jobs. The first slow year of starting a business. Early retirement before Social Security kicks in. Any year your income naturally dips is a golden opportunity most people let slip by completely unused. Step 4. Keep detailed records of your cost basis on every investment. Most brokerages track this automatically now, but double-check it, especially on older investments or anything transferred between accounts over the years. Step 5. Talk to a tax professional before executing a large version of this strategy. State taxes may still apply even when your federal bill is 0, and the exact income thresholds shift slightly every single year for inflation. I want to be clear. This is not a gray area. This is not aggressive. This is written directly into federal tax law, and using it requires zero risk of audit when done correctly. It simply requires knowing the rule exists and planning your income around it instead of stumbling into it by accident. Most people go their entire lives never learning this rule exists. Not because it's hidden, because nobody ever bothered to explain it in plain English. And what I just showed you is only the surface. There's a second strategy, one specifically designed for people who earn too much to normally qualify for one of the most powerful retirement accounts in America. And high earners are using it completely legally every single year. If this opened your eyes to what the tax code actually allows, don't forget to subscribe for more finance breakthroughs like this one. Because the next video breaks down exactly how high-income earners bypass Roth IRA limits completely and legally. You won't want to miss it.